Okay, great. So this is the last set of 5 questions. And really, this is a cash flow statement. We're really doing T accounting here. That's really the safe space. Just T account everything and it'll all come out. So let's go to, I'm going to go to a blank screen. So I think you need to kind of keep this alive so you can sort of flick through and see what's going on. And then I'll just put the numbers in as we see them, right? So let's go. So I'm going to go to a blank screen. I literally just need to create T accounts for everything. That's really the only way I'm going to capture, make sure I don't lose anything. So here, here are my non-current assets. So here we have here the opening. I start off with 13. I'm just going to go rough, 13,918, and I'm told that I finish with 16,104. So let's just go back there again. And I'm told I finish with 16,104. Then in terms of taxation, you just put everything into T accounts. Taxation, which of course you have deferred and current taxation. These are your opening figures here, 108 to 250. Your closing figures are 234 and 300. Yes, these are your carried out figures. These are your opening balances. And then you also have profit, which is a T account in effect, as I'm sure you're happy with that. And you start off with 8824, and you have a closing of 8951. And let's just go back and see. So we've done that. In fact, we've done this, we've done this, we've done this, and we've done this. And then we have this business over here that we'll come back to. Okay, great. So now let's look at the adjustments. So it says additional information, item of plant, carrying amount 965, sold at a loss of this during the year, depreciation of 2395, and during the year, and then during the year we acquired some new assets, rights of use assets, right, of 960. So this is good. I mean, I know you've done this a while ago, but it's good to come back to it and look at it and actually read through the question again, even though I'm reading it through quickly. So let's go back to our double T accounts. So literally, I'm just here in this non-current asset. Here we dispose of something worth 965. Open your disposal. 965. It says you made a loss of 50, so it means that what you got in the bank was 915. Then it tells us that you had depreciation of 2395, so you have a depreciation expense count of 2395. And it says that you bought this right of use lease 960, and you have right of this is the right of use, and here you have the lease liabilities. Lease liabilities of 960 as well. And we're done, literally. I just changed my pen color just to kind of close out. So going through the questions, let's just go through the questions now one by one. And that's the way to tackle this, and then just go through each of them. And the first question says, what should be recorded with regards dividends? So dividends, pretty much, I'm going to go straight to the profit statement. So I come over here. So I'm told that my profit during the year that's given to us, of course, profit after taxation is 627. If you like, so all I literally do, if this was what we started with, we added this profit, but we only have this left, it means that we must have divvies paid out here, and that balance is 500. If you like it, so your answer there is A. If you look at that, so that's A. Now that's pretty much it. Just find out what the missing figure is. Then next, relation to tax paid, go back to the thing again, just go back to tax. Here we have taxation, so you start with this, bang, bang, and then it says that your tax charge for the year is 672, and therefore, if this is your closing, this means that you must have paid that to the bank. You do that, and that's 496. Done. And that takes you to B. Then what should be recorded in relation to purchase of property, plants, and equipment? Again, we just go back to this our scenario here. Property, plants, and equipment. I literally need the closing figure in effect, because this is my carry down, isn't it? Brought down 16104. So this thing over here is 4586, and that's me done. Closed out, and that takes me to A again. And this is a kind of asking me what happens with regards to statement of cash flows for profit from operations. Depreciation is always added back, right? Of course. All losses, all expenses are always added back. So this is an expense. So this should be added, not deducted. It's gains that are deducted, isn't it? So only statement 1 is correct. Remember, cash flow from operations. I'm sure you're happy with that. Working on those movements. And in terms of lease liabilities, so in effect, the interest paid, I'm sure you're happy with that, will definitely go in operating activities. So it's either this one or this one. So we're dealing here in effect. And so with the lease liabilities, in effect, you have taken out a loan if you like to buy these assets. So it's not really investing. Really, it's the fact that you have taken out a loan to finance those right of use assets. So according to the standard, there is debate on it and people talk about it a lot. So you'll see this in the second year when we come to look at the conceptual framework. But the standard currently requires you to recognize the liability within financing activities. When you're paying off the liability element, then of course there's the interest element. So separating both. So your answer is B over there. Cool, great stuff. And that's the end of those three, and the last 5 questions.